After making 600 videos for my channel covering algorithmic trading, I realized I left out something that really goes back to when I started trading. The fun that trading really is. So I've decided to start a whole new series demonstrating a lazy way of trading. Trading for fun. This is really the only way to learn and enjoy the process. If you spent any amount of time watching the market, you could see traders having anxiety all over the place, worrying about whether something is going up or going down. Even in just looking at the screen, the red and green constant flashing of all of these markers creates a sense of urgency. And that doesn't need to be that way. Trading should be a hobby. It should be fun. It should be enjoyable. And it is. And that is what I'm going to show you in this new series. I'm going to show you just how enjoyable trading can be by showing you a lazy way to trade. You don't need to watch the market every day. You don't need to panic if the market goes up or goes down. This isn't about winning every single trade. It's about simply enjoying the process. You can enjoy trading the same way somebody enjoys painting or fishing or building models. So let's get into the chart and actually go through how I learned how to trade. The very beginnings that got me hooked. Long before algorithms and mathematics and fancy equations. Something that I could do on my lunch break or on the weekend and just be completely relaxed about it. So let's start with a very simple screen, the chart. This chart can be Think or Swim, it can be Oanda, it can be Interactive Brokers, it could be Yahoo, it doesn't matter. All charts have basically the same information, and that is whether or not price goes up or price goes down. Let's get rid of all this crazy flashing and actually just look at the chart. It's a simple chart, really, and that's the whole beauty of the process. You don't need to be complicated about the process. We're going to learn a few terms along the way, but really, it doesn't matter because they're easy to learn and they're simply a natural part of the process. So let's zoom in and look at the chart. What we have on the screen, red and green bars, are called candles. Now they don't have to be red and green. And in fact, some applications let you, the user, turn them to whatever color you want. But this is the traditional value. And they have a very simple meaning. Red bars means price has gone down. Green bars means price has gone up. That's pretty simple and straightforward. Easy to understand. And when we look at the market, we can see where the market is going with this information. Right now, the market on the daily time frame is currently going up. Price is increasing. Now, of course, time frames are a new word, but what does that even mean? Well, the time frame is nothing more than your window in terms of what price is doing, in terms of what buyers and sellers are doing on the market. The tug of war that is going on between them. That is all the time frame shows. By looking at the daily candle, we see a big picture. We're looking at the entire pie. And right now we see that the buyers are controlling the market and driving price up. But if we go to a smaller time frame, say the 5-minute, all that means is that we are looking at the current day, today, in 5-minute intervals. And we're seeing a real-time, back and forth tug of war between buyers and sellers. People just like us, who believe that the market is either fair priced, priced too low, or too expensive, and will buy or sell based upon that thinking. We can see by looking at this chart that the market has had a bit of a curve, a bit of a cycle. It's a simple process, and we can see how it all fits together. Now, we're not going to get into a lot of the overly technical words because we don't need to. We are going to cover a few basic things, though. So let's start with one of the candles. Let's look at this red candle right here. And this applies to every red candle. Red candles mean price is going down. There are more sellers than buyers. Now, the way that works, the way we know what this means, is a candle has an open price and a closed price. For the 5 minutes that this candle is counting, the open price is the very top of the candle. I'll demonstrate it on this candle since it's not moving. The bottom of the red candle is the closing price. That is where price was after 5 minutes. Simple and easy. The little lines that stick up and down, those are just called wicks or shadows, and that shows you how far the buyers and sellers had their tug of war. Think of this as literally the game of tug of war, where the buyers and sellers are constantly pulling price from one side to the other, or in the case of the market, up and down. This applies to every market: Forex, crypto, stocks, futures, oil, gold, it doesn't matter. There's always a tug of war between buyers and sellers. It's an easy process to see. Smaller time frames let you see more information about that window of time. For example, a 5-minute time frame versus the daily time frame. And the daily time frame, of course, being the most last candle, which is today. But both parts are identical. Which time frame you trade on doesn't matter. I personally like to stay mostly on the daily for my lazy trading because I get a bigger picture. I can see where the market has been, and that helps me guess where the market might go. So let's actually see what that looks like. Let's zoom out and look at the market. And here we are, going all the way back to March of 2024. We see pretty much a year's worth of information. I like to look at this chart because I can see that within that year, prices remain stable for quite a while, or what we like to call a range. But then after that, prices shot upwards, or what they like to say is a breakout. The words really don't matter, and don't get caught up into the technical nuances of what that means, because it's just jargon. Price stayed the same, price went up. That's all this means so far. And now we see we have another range. A lot of people don't like ranges. I love ranges. Ranges equal consistency, and ranges happen 70% of the time. Most of the time, the market is going to be in a range. So if you want to really enjoy trading, then looking at ranges is going to be a commonplace. And of course, buy low, sell high is the whole point of trading. Well, that's perfect for a range because you can see where that range is. So at this point, we've covered a few words, but don't worry about getting caught up in the technical jargon because it really doesn't matter. We have the chart, we see where it's going. Right now, we see the market is going in an upward trend. But where? Where is this market likely to go? Well, for that, we have other time frames. We have the daily, the weekly, which shows even more information about the whole history of the asset. And we can see going all the way back to 2016. We can see that we are in a popular ranged area. In other words, this is where the market likes to stay, where prices are considered fair value between buyers and sellers. You might get a cheap region here, but as you can see, it only happened once throughout the whole history of this asset. Euro Canadian is a cyclic asset. That means, typically speaking, price remains fairly consistent in the range it's in. That's wonderful for learning how to trade because more than likely prices are going to be long-term within this range. So now let's look at the highest time frame. And we see that it's really not that different. So we have the whole time frame, and we can see that the range we are in is still pretty consistent. There are a few areas that have dropped below it, and a few areas that have gone above the range. But for the most part, the price that we're dealing with is remarkably stable. This is a wonderful asset to learn how to trade with because it is so stable. There are a lot of different markets that are just crazy, like Bitcoin. They're unpredictable, they just go anywhere and everywhere, and they can make it difficult to learn. Finding a market like this, or finding a market that you enjoy or you want to learn how to trade, is really the best approach. That is the whole point here. You must enjoy trading to really get to see the opportunities of it. Trading is fun, just like fishing, just like painting, just like pottery. The lazy way of trading is about you finding a method that works for you. Trading is a personal journey. There are 1,000 different ways to trade a market, and none of them matter if they don't resonate with you. Trading is about you finding the asset that means something to you, whether it's your national currency, whether it's a curiosity about the market or something in the market structure, whatever it is that makes you fascinated with that market. That is what will help you make the most money, make the best decisions, and remain the most enthusiastic about what you have to trade. Don't be worried about blowing up your demo accounts. Research, read, find the asset that makes the most sense to you. When I started, because my national currency is the US dollar, that's where I started to learn. But over the years, I became interested in other currencies. I saw things in the market, like what I just demonstrated, that made me interested in this market because of its unusual stability, the unusual range that this market shares over a long period of time. It made me really want to learn more about this market and the interesting connectivity between Europe and Canada. That is what drives your interest in the hobby of trading. Your interest, your willingness to want to know more about the hobby. For example, if you're doing models, you want to know more about those models, whether it is World War II aircraft or perhaps NASCAR cars. You have an interest in that area, and that is what drives, what fuels your hobby. Here, my interest is the fascination between the buyers and the sellers, how millions of people worldwide can shape the value of the currency by whether they believe it is overvalued or undervalued. So we have a basic chart. Let's start with, how do we even make sense of this? I have two simple things I use. Basically what I've demonstrated already, which is simply drawing on a screen. I like to draw on my screens, and this tool is just one of them. But I also like to use the application to use its tools. and I like to go to a higher time frame. Look at the chart. Find out where the market is. And then I'll use a line. And I will draw a line on the screen. So we're going to use a horizontal line, and I'm going to put it right here. I'm going to make this line yellow. You can make it whatever color you want. Now why? Why did I put this line here? Well, because as we look at the market, we can see that this line is the upper boundary of where price typically doesn't go beyond. It helps us see just where price is likely to remain, where buyers and sellers have agreed that, okay, this is too expensive. And we can see going all the way back to 2011 that buyers and sellers have agreed that anything above the yellow line is too expensive. Now we do the same thing with the bottom, with the lower range. And we draw a line here. Now I like to keep my lines the same color, but again for the same reason, looking at where prices have gone. We can see it dipped here a little bit, but for the most part, it stays pretty constant in that range. It has a stability, a pattern of trade. And we can see within this range that right now we are at the high end of the range. So if we want to get into the market, because price is likely to not go above the yellow line, we want to get into the market for the price to go downwards. That is, we want to short the market, because we see from the chart that the market is likely to go backwards or downwards. So that is how we do it. But this is really all you need. Just very simple tools. We can see exactly where the market is, and we can see exactly how it works. So let's zoom in a little bit. In fact, let's go back to the daily. And let's see if I can find my yellow lines. As you can see, you can scroll the chart. And there's our yellow lines. We've shrunken things up a little bit. So now let's expand this where we can see there's the yellow line. There's where our price is. Right now, our price compared to the upper boundary or the upper resistance of the market. So we've got a little bit of ways to go. And the market could very well go that way, but we can see by looking at the market right now, for at least the last month, it hasn't gone above this level. So we can see that we have another area that the buyers and sellers have agreed to stay within for now. There's no guarantees, of course, what that will be in the future. But for now, we have a reasonable level of confidence that this is where the market is going to be. So let's zoom into that. let's actually go in and see where this is at. We can see the candle is at the midpoint. That is the upper wick to the lower wick. Right now, the current closing price, where buyers and sellers are at, is roughly midway. Throughout the day, we can see where that market has gone. And by checking the other time frames, we can get more information. But for the way I like to trade, I have enough information to make an informed decision. And my decision would be to open up a short trade or to sell a position on the market. So, thanks to this platform, Oanda, it's easy to do that. But any demo account makes it easy. It's just a matter of knowing what your account is capable of doing. So we can see right now, the current price is this dashed line. So we see exactly what the market is doing. But if we look at the price up here, we can see the selling price, the buying price, and a little price in the middle, or what is called the ask spread bid. You'll notice that the buying and selling prices are not the same. There's a reason for that, and that spread is part of the reason. When you get into the market, that spread affects your price, and that helps push the market one way or the other. I'm not going to get into the technical jargon of it because you really don't need to know all of that right now. The only thing you need to really know is that the spread should always be looked at. Typically speaking, I personally don't like getting into any market above 5 pips. So when this little number is above 5, I don't like to purchase. It's a habit of mine because the higher that number goes, the less profit you make when you do finally get out of it. So that's not something I like to do, is go above a 5. If I can get it 2 or below, better for me. But 5 is my hard limit. So now we know what we're doing. We can either, 1, open up a longer position where we believe that price is going to go up. That is, price is going to get closer to the yellow line we made earlier. Or we can open up a short position because we believe that price isn't going to go too far above this zone and that we are going to actually go down in value. For the purposes of this demonstration, I'm going to open up a short position because I think, looking at what I see on the chart, I think the price is going to go down. And it's going to go down enough that I can make $1 or $2. So let's actually look at what that really looks like. So to open up a long position, you click on the buy button. To open up a short position, you click on the sell button. And you can see the price that you're going to get. So click on sell, and now it asks us how much we want to short the position. This account has $1,000. Proper trading, meaning you don't want to blow up your account. So proper trading means your position should not be more than 1%. So if you have $1,000 account, then your position should not go above $10. This is called risk management. And we're going to learn a lot about this over the course of these trades, because this is how you protect your budget. So let's start with figuring out exactly what $10 is. And you will see that here in the margin. Remember that Forex is a margin-based account. That is true when it comes to a lot of different accounts, such as crypto or even stocks. So we're going to try to get the margin required as close to $10 as possible. And it's simply going to be trial and error. So let's see what we come up with. Well, let's do 500 units. 500 units is $11. In Forex, you purchase the size of units. I want to stay as close to 10 as possible, so let's just play with the numbers and see what we get. So 450 is too high. Okay. Well, that's definitely not good. I want 420, not 4,000. Okay, so 956. And there we go, 979. Let's try 440. That's close enough. Again, we don't have to be perfect, but I just want rough. So 440 units is going to give us roughly a $10 position. Now that we know what we want to purchase, let's start with how much profit we want. How much money do we want to make on the basis of this going down in value? Well, to do that, we can use the TP value, or take profit. For the purposes of this experiment, we're not going to worry about the other functions. We're simply going to set a take profit. So we click on it, and now we have our price, and we draw where we want the take profit to be. And as you can see, we get a number. These numbers here actually give us a clue in terms of what our take profit is going to be if the price drops to this level. Right now it says $3.45. So let's play with this a little and see if we can get it to roughly $3. It's going to take a little bit of time, and it doesn't have to be perfect, but there we have roughly in range. So we have our take profit of $3. So basically, we have a $10 position, we have a $3 take profit. If this works out well, we will have a 30% profit. We will make a 30% profit if the price drops to the green line. This is really the basis of trading. Now, I'm not going to get into the other two buttons as I said. Not yet. In time, we will. But for now, let's just stay simple. So now that we have our first trade, we click on submit and the program will give us our trade. It will ask us to confirm our order. We will click on it and we have our first trade. So now we just wait. Could be a day, could be a week. It doesn't matter. We simply wait. That's it. That's how easy it is. And we see if whether or not we were right based upon what we see in the market. So if we go back to the higher time frame and we look at just exactly where our order is in relation to the yellow line, we can see we made a good call. Now we just need patience. And that, of course, is the whole point of the lazy trade. We simply close the app and go on with life. And it will give us a notification if it crosses the boundary, or the next day when we check it, we'll see what the new price is in relation to where our green line is. I hope you found this video fascinating and a nice eye-opening way of looking at trading in a completely different and relaxed way. Please continue to follow me in this series as we simply have fun. I really do want this to be the Bob Ross of trading, because it doesn't matter if we're right or wrong with this technique. That's the beauty of it. Hit that thumbs up and like the video. Help me grow the channel and get other people interested in the fun of trading. Thank you for watching.